Well, good afternoon and welcome to the IIMA Public Policy Alumni Special Interest Group webinar series. As you may know, the IIMA Public Policy Alumni Special Interest Group is a group of alumni and faculty of the Institute with expertise and interest in the fields of public policy and development. It fosters collaboration among the IIMA community, which is faculty, students, and alumni, and the wider world of public policy practitioners to contribute to India's inclusive development agenda. The webinar series aims to bring the thoughts, views, and expertise of renowned experts to the IIMA community. It gives me great pleasure today to launch a new webinar series on the cryptocurrency and regulation of official digital currency bill 2021. Now, some of the cryptocurrency related themes that we will try to cover and explore as part of the series are on 6 broad themes. Integration with existing financial ecosystem, which is RBI, SEBI, banks, fintechs, Indian and international regulations such as FATF, KYC, AML, FEMA, LRS, investor protections, etc. Then we have taxation, that is treatment in terms of asset class, capital gains, time horizons, tax rates, etc. We have legalization that could cover, probability of ban, ambit in terms of companies, individuals, scope, legal backing, penalty, retrospectiveness, implementation, recourse. Then we have, blockchain experimentation, which includes, sandbox, non-financial use cases, blockchain without cryptocurrency, etc. And finally, impact on the economy in terms of, job creation, wealth creation, building up, talent pool. The public policy SIG will be bringing over several experts in the field to share their perspectives with us in each of these niche areas. Kamal Gaur, PGP 2004, who is here with us today, will help us conduct the discussions with the invited guests. Kamal is a blockchain enthusiast who is passionate about helping people understand the world of blockchain, Bitcoin, and cryptocurrency. In his non-crypto avatar, Kamal is a management professional with experience across various domains, including analytics and strategy, and is currently based out of Bengaluru and Mumbai. Kamal has graciously volunteered to work with IIMA Public Policy Alumni Special Interest Group to drive this webinar series in which he will be talking to multiple stakeholders to better understand the space and to come up with a set of recommendations towards public policy. Towards today's session is an introduction to blockchain, Bitcoin, and cryptocurrency. Welcome, Kamal. Happy to have you over. Now invite Kamal to take over the proceedings and start his session.
Sure. Thank you so much, Anurag, and thank you everyone involved in inviting me to this webinar series. So what I will do now is let me share my presentation, right? And let me know when you can see it. Yeah.
We can.
Okay. All right. So what we will do is we will spend the next 60 to maybe 75 minutes going through content, which essentially talks about blockchain, Bitcoin, and cryptocurrency. I have usually done this session in formats where the discussion is a lot more interactive. However, today we will not be in an interactive mode. So I will just run through the slides. And if you have any questions, you can obviously leave those in the chat and we will try to maybe offline circle back with some of those answers. The hope is that by the end of the day today, most of the questions that people might have will be covered to a certain extent, right? So with that, this is what the agenda looks like. I have about 55 odd slides. We talk about Bitcoin, we talk about why it's a big deal, we talk about blockchain, we talk about the legality of Bitcoin in India and around the world. If one wants to get involved in cryptocurrency, what is the process? What are some of the reasons why people might not want to be involved? And at the end, a bit of advice if people are looking to get involved. Right. So with that, just a disclaimer, which is that the slide contents at the end of the day belong only to the understanding that I have, right? And I do not end up representing my employer or any other group. It is at the end of the day my understanding of the content, and because of that, it is limited by my own knowledge on the topic. And at the end of it, one should not construe any of this as financial advice. Yeah, and one last fair warning, which is that the content might get a little geeky in a couple of slides. And the reason I'm calling that upfront is that so that people can switch on in those parts instead of switching off. Yeah. So this is a reference to the matrix, and this is the choice offered to Neo, which was to take the blue pill, the story ends and you wake up believing whatever you want to believe. And if you take the red pill, you stay in Wonderland, and I show you how deep the rabbit hole goes, right? And this is for us an entry for the next hour or so into the world of cryptocurrency. So when we start thinking about Bitcoin, and Bitcoin is probably what people have heard the most of, right? When you look at what Wikipedia says, it says that Bitcoin is a cryptocurrency, which is a digital asset designed to work as a medium of exchange, which uses cryptography to control the creation and management rather than relying on central authorities, right? And cryptography is actually a method of protecting information so that only those for whom the information is intended can end up accessing that information. So the question that many people will have is, how can Bitcoin be a currency when no government of the world has instituted or put it into existence? For which actually what we need to do is to start understanding what is money. And if you look at the definition, right, it basically says that any item or set of verifiable records that can be accepted as payment for goods and services and repayment of debts and also taxes in a country or a socio-economic context, that is what can be constituted as money. So the main functions are, it needs to be a medium of exchange, a unit of account, a store of value, and in the case of taxes, a standard of deferred payment, right? Anything that satisfies this can be considered as money. And here, historically, we have seen that it was commodity money that started off a few hundred years ago. But in today's world, pretty much all monetary systems are all fiat, right? And there is this infographic which talks about what are the requirements to qualify as money. And the infographic basically says that there are 7 parameters. It needs to be durable. Okay, 1 second. Yeah. Yeah. So the requirement is that there are 7 qualifications, right, for something to be constituted as money. One is durability, which means you should be able to use the particular currency multiple times. 2, it needs to be portable. 3, it needs to be uniform. 4, it needs to be limited in supply. The 5th one is actually what is known as fiat, which means that it is mandated. It needs to be acceptable by everyone, and nobody should be able to refuse the use of that particular currency. 6, it needs to be divisible, which means you will be able to divide rupees into paise, dollars into cents, and so on. And finally, it needs to be fungible, which means that $100 in my hand is the same as $100 in your hand. And if we exchange notes, it doesn't really make a difference. And each of the currency units is fungible. So these are the 7 parameters, and anything that qualifies for this can be known as money. Now, if you look at currency, the definition says that, it is a system of money in common use, especially for people in a nation, right? But it says especially, not necessarily. Historically, like we said, it's either been fiat currency or underlying assets. Commodity money, we've had gold, silver, copper, and the others, where the objects themselves have value, which is intrinsic, right? And hence they end up getting used as as money, which also has value, right? Contrary to popular belief, the fiat money that we use today is largely backed by the faith and credit of the issuing government. It does not, at the end of it, have intrinsic value beyond what it represents, which is the power of the government and the promise to pay the bearer the face value of that currency, right? And it also ends up being, it also ends up getting value because of the fact that the government has declared that it needs to be treated as legal tender, which means that it must be accepted as a form of payment within the boundaries of that country, right? So in India, if you want to go buy something and you go and offer them rupees, they cannot say, no, we will not accept rupees, because rupees in India are fiat money, and by law, everyone is legally mandated to accept it as legal tender. Now, when we look at the two types of monetary systems that we were talking about, right? One is commodity, the other is fiat money. We talked about how the value is absolute in one and relative in the other. The origin of that value is intrinsic in one and assigned in the other, right? Similarly, if we look at what determines the actual value, in the case of commodity money, it ends up determined by the marketplace. In the case of fiat money, it's usually the monetary policy of that country, right? So at the inception, when the dollar was created, it was backed by gold and silver. And like we said, every unit of currency was like a receipt for the face value, redeemable in gold and silver, right? In 71, Nixon decides to go off the gold standard. And as a result, the government gains the ability to print as much paper as it wanted, right? And there was no collateral behind that money except the US government's promise to pay, right? Not a lot of people will realize this, but this currency printing comes at a price, and it ends up leading to inflation, which is like a hidden form of taxation, which ends up destroying everyone's the buying power of fiat currencies that you are holding your assets in, right? Fun fact, none of the governments around the world are using the gold standard today. And if you look at this infographic on the right, it shows that the monetary base of the Federal Reserve has touched about 5.5 trillion sometime in late 2020. I did see an infographic on Twitter the other day, which showed that it's actually gone up all the way to about $8 trillion, right? And as you can see, it's only in the last 10 or 12 years that a majority of this currency printing has happened, right? So now that we've talked about what is money, what is the definition of money, what are the different forms of currencies, fiat, commodities, the question that a lot of people might be asking is, what is the X factor, right? Is it as simple that somebody can just create money out of thin air? Because that's what people are saying, right? And that's one of the reasons why people are skeptical about cryptocurrencies, including Bitcoin. So the X factor ends up being that at the end of the day, you just need enough people to believe in the value of the currency, right? So if you go back to the example that a lot of us are familiar with, which is the demonetization example, what you will read in some of the news reports is there were markets in Mizoram and maybe other parts of the country as well, where because there was no physical currency available, people actually went back to using handwritten coupons, right? And markets were still functional. So the point that one's trying to make is that as long as a set of people collectively agree to believe in the value of something, it will hold value. And the same demonetization example, the minute by law or by announcement, the way the government said that, you know, the 500 and the 1,000 rupee notes will not have any value going forward, immediately within 4 hours, all that money obviously lost its value, right? And that is the risk when it comes to fiat currencies, right? And like we said, as long as people believe, mutually agree to believe, it will continue to hold value. So before we get into some of the other elements of Bitcoin and where it came from and why it probably got launched at the time that it did, let's also understand what's the role of money management and how does trust play a role, right? So if you look at the regular financial banking ecosystem, at least on the retail side, right, you have depositors who are in millions, who go and deposit their money into hundreds of banks, who give it out to thousands of borrowers, who go out and put it into hundreds or thousands of investments, right? What ends up happening is when some of these investments don't work, right, and the money stops coming back from those investments to the borrowers, to the banks, it ends up going downstream and obviously impacting the depositors, right? So a lot of people wonder as to how can people who have put in their money in a regular financial regulated bank end up losing that money, right? That is because there is and this is what human nature has shown and history has shown, there is a problem that we have globally in terms of misplaced trust, right? And things go wrong and everybody else ends up losing their investments. So, and this is just, again, simple 101, which is to say that the money that you see in your bank account, which you think is available, the fact of the matter is that all of that money is not sitting in your bank. It is a ledger which is shown to you that obviously the bank owes you an X amount, which you have deposited. But up to 95% of that money has actually been lent out to other people who are obviously using that and will pay it back as borrowers do to the banks, right? So in India, it's 95%, which means the reserve ratio is a minimum of 5% that banks have to retain for every 100 units of currency that they have, right? And this is, again, something that we've seen in case of PMC and other banks which have undergone RBI freezes, is that when there is something known as a bank run, it actually affects the ability of the bank to stay functional. So now let's look at, for a minute, the regulations that have been there, especially in the US, leading up to the introduction of Bitcoin, right? So if you go back and you look at what happened in the Great Depression, after that, there was a GlassSteagall Act, which was put in place to make sure that commercial banking and investment banking were separated, and banks weren't allowed to actually play with depositors, retail depositors' hard-earned money, right? That ended up getting diluted from the 60s onwards. And a lot of experts have blamed the 2008 crisis on this very dilution, right? So in 2010, Obama signed the Dodd-Frank Act into law to protect consumers from a similar future crisis. And just to give an example, like I was saying, when a large number of people end up trying to withdraw the money from a bank, it's known as a bank run. When in a country you have multiple banks suffering bank runs at the same time, it's referred to as a bank panic. And a systemic banking crisis is basically when almost all of the banking capital in the country gets wiped out, which can have fiscal costs or economic output losses between 13 to 20% of the value of the GDP, right? So the reason why I'm bringing all this up is to talk about the context in which Bitcoin actually came into existence, right? So the question is, when did most of us end up hearing of Bitcoin, right? So a lot of people I know heard it in 2018. Some people maybe heard it this year. Some people heard it in 2017. In my case, particularly, I remember discovering Bitcoin as a concept, I think in Jan or February of 2013. But back then, one could just read up about it, and there was no real way to actually understand what a wallet was or how to use a wallet, right? So for me, the discovery happened then. But for me, the seriousness of being into Bitcoin as a space and cryptocurrency as a space, my actual learning ended up starting somewhere in 2017, right? But like they say, every overnight success is about 10 years in the making. And the white paper, and this is a 6-page or an 8-page white paper written by Satoshi Nakamoto. And I would recommend anybody with even a slight interest in the space to actually go and read up about it. This was released in the year 2008 in the immediate aftermath of the financial crisis, right? And the reason, and as we go through some of the slides, you will understand why I was giving that context, because what Bitcoin sets out to solve through the technology of blockchain is the risk that we were talking about when it comes to centralized decision making, right? So before we go further, some questions, some highlights around why Bitcoin is a big deal, right? One, it is not controlled by a centralized single entity, which actually, believe it or not, is actually ending up being a good thing. Two, it cannot be shut down or taken offline unless you turn off the internet, right? Three, the code is designed in a way that the supply is limited to 21 million Bitcoins and no more, right? And there is nobody who can unilaterally go and say that, you know what, actually, I want more Bitcoins and let me change the code and let me try and get this increase to 22 or 23 million, right? Because of this, it ends up being seen as a hedge against inflation, which is inherent to most fiat currencies, if not all, right? The code is open source and verifiable. So if you understand code, you can always go download the source code, read up on it, and understand why Bitcoin works the way it is and what has been coded into the software. Which also means that it is something that you cannot really counterfeit, right? The way we have heard governments around the world talk about the challenges of counterfeiting for fiat currencies, you can't really do that in the case of Bitcoin. Um, Finally, another reason is that if you look at the existing financial system around the world today, right, it has been set up to extract a certain revenue from the value that it provides to the worldwide network, right? So all the different banks, currency exchange rates, all of it end up actually taking about 2 to 5% of your money if you are looking at transferring money across borders, right? Bitcoin as a technology, Bitcoin as a currency, and along with Bitcoin, many other similar currencies end up undercutting this, right? Because at the end of it, when you look at Bitcoin or any crypto, the transaction fees that are involved uh, are not linked to a percentage value of the amount that one is looking to transfer, right? So you could be transferring $100 or $100 million. At the end of the day, the transaction fee will be the same flat fee. Um, it is also a big deal because since last year, institutional interest has been growing. MicroStrategy has ended up buying in the last 8 to 10 months about 92,000 Bitcoins for about $2.25 billion. Tesla became the first company from the Fortune 500 to buy BTC as a reserve asset. As of March, Square, which is a company owned and run by Jack Dorsey, who is also the CEO of Twitter, Square has bought about 8,000 Bitcoins. Similarly, in March, PayPal announced that it was starting to let US customers use their crypto holdings for making online payments to over 26 million merchants that are on the PayPal platform, right? So a lot of institutional interest has been growing. Um, uh, and this is something that we've seen in the last couple of weeks as well, right? So even from a point of view of countries, there has been interest that is growing. So El Salvador announced earlier this month that it was adopting Bitcoin as legal tender. And there is a website which lets you actually go and check which countries own how much Bitcoin. And it turns out that Bulgaria as a country owns about 213,000 Bitcoin, and Ukraine owns about 46,000 Bitcoins, right? Finally, and this is a little dated, apologies for that. Bitcoin's market cap right now is not about 1.1 trillion. It's, I think, about 650 billion. But if you look at gold, which is what Bitcoin ends up getting compared against, it's about 10 to 15 times. Gold is 10 to 15 times bigger, right? And as you will realize through the course of this session, Bitcoin in many ways is a better asset. It's easier to hold, divide, carry, and move as compared to gold. And people do expect, there are a growing set of people who believe that Bitcoin's market cap will end up getting bigger because it will end up taking a share of the pie, which is currently uh, managed by gold. And finally, another reason why people say that Bitcoin is a big deal, which is the fact that the largest wealth transfer in human history is going to come in the next decade or so. It's about $60 trillion worth of assets which are going to move on from the generation, which are the baby boomers, as they pass away, and then it goes to their offspring, which is usually the millennial generation, right? So even if a fraction of this money ends up entering cryptocurrency, and we are seeing more and more studies which say exactly that, right? The potential for price increases, obviously, in the crypto space becomes astronomical, right? And we have seen that millennials have already started showing a preference for digital assets. So these are some of the highlight reasons why Bitcoin is such a big deal. And then when we talk about valuation frameworks, there are four different types of valuation frameworks that one would probably consider when arriving at a valuation for gold, right? One is obviously what we've all heard over the years, which is that it's the equivalent of tulip mania. It has no comparative advantage, and it's just a bubble that will eventually pop, right? And as part of that, people believe that the long-term target price is zero, right? The other valuation framework is that Bitcoin is supposed to be a new monetary technology, and the appeal will be largely to the technologically savvy and libertarian people who can tolerate the volatility, right? And in that framework, the target price for the long term is expected to be between $10,000 and $100,000. The third one says that it's a new monetary good, which will disrupt the closest cousin, which is gold, which is what we were just talking about. In which case, because it is superior to gold in many ways, the long-term target price is expected to be between 300,000 and $1 million. And finally, there are some people who believe that it will ultimately become the world's reserve currency, and it will basically end up draining the store of value premiums out of every asset that is out there, because of the fact that obviously any premium will go towards something which is a scarce resource like Bitcoin, in which some people believe that the long-term target price is about $10 million or more per Bitcoin, right? Like we said, initially, uh, the framework number one was dominant, but right now you have very few people who believe that actually it will end up going to zero, right? As time goes by, the non-zero probability of it reaching zero keeps diminishing, right? Right now, most people do believe that it would be either framework two or framework three. And then there are some who believe that once two and three were to happen, it will obviously eventually lead to the fourth valuation framework, right? Uh, at this point, I also want to talk about this question which we all hear about, which is that what is Bitcoin's inherent value, right? It's not like any company. It does not have physical assets. It does not represent shareholding, which is something that can be linked to cash flow. So how do you uh, ascertain or ascribe value to Bitcoin, right? So the way I see it is that the worth of Bitcoin is based on what it represents, not what it is. At the end of it, it is still a bunch of bits and bytes, right? It is access to a ledger which shows a certain balance, but uh, what the way to interpret the value is what it represents in terms of the scarcity, right, of that network. So if there are multiple things which attach itself to the Bitcoin network, and those have value, then by association, the Bitcoin network ends up getting that value, right? And buying then a unit of Bitcoin would mean that you buy yourself a unit of 1 upon 21 millionth fractions of the value of that particular network, right? So with that, what we will do now is get into what we mean by blockchain, right? And this will be the part where we get into the basics, get into some specifics, and then move on to other things around Bitcoin and regulations and all that. So when we talk about blockchain, it's at the end of it a mathematical way of managing a ledger of accounts without needing to trust a third party. So the trick is, right? Uh, so if you are using blockchain and this is a blockchain network, the way it works is every transaction made by every individual is broadcasted as information to everyone on the network, right? And all the people on the network keep a record of what they are coming across as broadcasted information. So the actual trick is, instead of depending on one single third party to be the decision maker, you end up trusting multiple third parties. So the way blockchain works is you do a polling, and whatever is the consensus given by the majority, um, that is uh, uh, that is what is referred to as majority consensus, and whatever 51% or more of the nodes end up deciding ends up being taken as the correct decision for the network and in terms of the transactions, right? So the way the blockchain is designed is that every few minutes there is a set of transactions which is verified in a block of info. This new block is added to the chain of blocks that have been getting verified from inception of the network back in 2008 till date. So it is one long chain of blocks getting added every 10 minutes. And that is what blockchain is, right? So the new block contains not only information about the existing transactions that have happened in the last 10 minutes, but also it is linked inextricably to the block that has just preceded this, right? And through the use of cryptography, you end up uh, connecting these blocks of information. And since every transaction is verified, timestamped, and linked to the previous one, you end up creating a chronological chain of transactions. And that is how blockchain ends up getting its name, right? So there are also uh, discussions that one comes across where people talk about blockchain being a good technology, but cryptocurrencies being a not so good outcome of that technology, right? So the question is, uh, what would blockchain be without cryptocurrencies, right? Is that even possible, right? So the point of view that I have is that it depends on who you ask, right? If the objective of the blockchain is meant to require that nobody can tamper with the records, then it is always advisable to set it up in a way that nothing is controlled by a single party, right? Now, the question that then comes up is, okay, if you have 100 independent parties or 1,000 independent parties, how do you incentivize them to keep the blockchain network up and running? One option could be that, okay, you say, okay, it's my blockchain, but then, okay, I will pay them in fiat currency and I will reward them for maintaining the network. The problem with that is then I become the single point of failure, right? And if I go rogue, I can then end up killing the blockchain, right? And if I say, you know what, I don't like the way the blockchain is recording XYZ information, I want to get it changed, I can then decide to influence only those nodes who are willing to toe the line and make certain entries. And over time, the rest of the guys will drop off, right? So the way to avoid this, and that is the way, that is the brilliance of how Bitcoin also as was designed, was that you end up designing an independent way to pay out those incentives. And the way, and this has to happen in a fair meritocratic manner. And it also has to be randomized enough so that everybody feels uh, like wanting to participate in the process, and nobody ends up feeling cheated, and everybody ends up having skin in the game, right? And this is what we refer to as the process of mining, right? But before we get into mining, let's quickly cover what are the nodes, right? And when we talk about nodes, these are the computers that are connected to the Bitcoin network using the internet, which are responsible for two things. One, keeping a copy of the Bitcoin ledger, which means just that dump, which is about 10, 12 years old right now, keeping that information updated, synchronized across all nodes, right? Which allows anyone to actually go back and look at every transaction that has ever occurred. Two, the responsibility includes updating the ledger every 10 minutes by adding the latest block to the chain of blocks, right? Mining is the primary incentive generating activity, which is performed by all these nodes. And these nodes at the end of the day are also known as miners, right? The incentive is for two things. One, to keep the ledger correct, which ensures that the payment network is trustworthy and secure. And two, it is to make sure that there are enough people and enough nodes which are keeping the network alive and resilient in the case of any downtime that has to happen anywhere in the world. So a simplistic analogy would be to say, imagine an Excel spreadsheet, which is on all of our um, uh, personal laptops or professional laptops, and it has a list of, say, a million transactions, right? And assuming we are all hooked up to something like a Dropbox, right, where any change made by anyone ends up reflecting as a change made in our ledger as well, right? So this is the analogy, which is a simplistic one for you to understand what a ledger means. And as long as the ledger contains all the information and it is in sync with all the other nodes, anyone in the network will be able to actually verify whether a certain transaction has happened or not happened, right? So when we talk about mining, there are two parts to mining. One is you want to tally all the transactions that have been broadcast on the network since the last block, which is about the last 10 minutes, right? And two, it is about solving a mathematical puzzle. Now, the tally part is easy, right? It's just a ledger. You just sum it up and just keep a tab of who sent money to whom and how much of the crypto units were sent, right? So the key ends up being to be the first one to end up solving the mathematical puzzle. And whoever gets the correct answer ends up getting the permission or the right to submit the answer to the puzzle along with the proof of work and the tally of the transactions that they have recorded since the last 10 minutes. And as a reward, the winning node is given a mining reward, which consists of two parts, right? One, freshly created bitcoins, which are about 6.25 bitcoins per block, which is per every 10 minutes. And two, the transaction fees that accompany all the transactions that the winning node has tallied since the last 10 minutes. So the way it works is once a block has been mined, the clock resets, a new puzzle is generated, and again, all the nodes are in the race to be the first one to get the right answer in the next 10 minutes so that they can then earn the associated rewards per block, right? And this ends up happening every 10 minutes or so, and this is what um, the mining process in some form looks like. Now, as we talk about mining, the other thing to also understand is, or at least be familiar with, is what is known as the proof of work, which is the difficulty level. So the way Bitcoin has been designed, and not all cryptos are based on proof of work. There are some which are based on proof of stake, but the way proof of work is designed is that there is a function f of x tends to y, which needs to be generated. And this is the equivalent of saying that, if you know x, you can quickly generate y. But by knowing y, it is computationally expensive to arrive at the original x, right? And this puzzle is about trying to come up with a 64-digit number, which is also known as a hash, which needs to be less than or equal to the target hash. So the way each of our computing devices has computational horsepower, your laptops, 2 gigahertz, 2.3, 3.1 gigahertz. Similarly, a miner's computer also is measured in terms of how many mega hashes or gigahertz or terahashes of information can it compute, right? At the end of it, it is a series of guesses that each of these mining nodes is doing, but the series of guesses still requires computational horsepower and it still requires time, right? And one analogy is that if you were to look at your Excel file, which is a heavy file, and if you have a VLOOKUP formula in that, and then you refresh it, the few seconds that it takes for your computer to calculate all the answers in your Excel file, imagine something similar happening across all the nodes every 10 minutes, right? Because all these mining nodes are in a race to be the first one to compute the right answer. So as of June 2021, this month, the difficulty level of the most recent block was about 1 in 21 trillion, which is the probability of a computer producing the hash, right? So this difficulty level ends up getting adjusted every 2000 or odd blocks, which is about every 2 weeks, right? And the objective of this difficulty level adjustment is actually to ensure that the block time stays as close to 10 minutes as is possible. So what happens is, if more miners end up joining the network, if the price goes up, right, and a lot of miners say, we want a share of the pie, we want to start mining, more miners come in. As a result, that means more computational horsepower has entered the network. As a result, logically, uh, the time that it will take for the answer to be found will end up being less, right? As a result, what ends up happening is the difficulty level goes up when more miners join in. So that instead of taking less time, it will still take 10 minutes. And similarly, if miners end up dropping off for whatever reason, right? We heard recently that in China, there was some clampdown in some parts of China where there were mining farms. So if those miners dropped off the network, in logically, it would take longer than 10 minutes for the remaining miners to come up with the answer. But in that case, the difficulty adjusts downwards so that it still ends up taking 10 minutes and not more, right? And just a fun fact, in case people are wondering, it has stopped being profitable for most people or anyone to actually end up using any of the consumer devices to end up mining Bitcoin, because what it will cost you in terms of just the running costs, the electricity and the internet and all that, that will probably end up being more expensive than the rewards that you will end up earning as the fraction of Bitcoin that you will end up earning as a reward. Yeah. So and right now, and actually since a while, you will see that most mining setups have gravitated towards places where either the environment is cool, so you don't have to actually incur cost on cooling, or you have renewable power, or you have cheap power, which is why we are also seeing some of those miners historically be set up in China, right? So talking about proof of work, difficulty level, now let's briefly talk about the block rewards, right? So the source code of the Bitcoin network was designed, like we said, that every 10 minutes, it self-generates fresh Bitcoins and adds it to the network by giving it to the winning node. This ensures an ongoing supply of fresh Bitcoin, right? And unless, uh, uh, yeah. And the other thing that to remember is that even when you think of gold, it is about 1.5% of supply that ends up getting added to gold every year, even globally, right? So the origin block, which was in 2008, right? Then there was, so there is a process known as halving, which happens every 210,000 blocks, which is approximately about 4 years. So the halvings have happened 3 times already. So from 2008, it's happened once in 2012, once in 2016, once in 2020, and it will keep going on and keep halving till the year 2140, which is about 120 years from now, right? At which point, it is believed that as the payout keeps halving and 50 Bitcoins goes to 25, which went to 12 and a half, which is now at 6.25, this payout will end up tending to almost zero at the end of 120 years from now. As of today, about 18.7 million Bitcoins have been mined. And at the end of 2140, you will have all 21 million coins uh, completely mined. And at that point, the network will stop generating new Bitcoins. And the only source of incentives will be the transaction fees that accompany all the transactions that are getting broadcasted into the network, right? And the hope is, and the expectation is that at that time, the value of those transaction fees, because of the value of the inherent underlying Bitcoin, will be more than sufficient to compensate the miners for the efforts that they are putting in, right? So coming back to the topic about blockchain without incentives, right? So there are uh, there are ways of looking at blockchain and how it can be used to create one-stop solutions, right? We have heard of companies looking at it as supply chain solutions for perishables, from farm to plate, and so on and so forth, or to find or to become the single source of truth for things like property registration or any other thing, right? The rule of thumb that you need to ask yourself is, for any blockchain solution, who is it controlled by, right? And in the case of blockchain solutions where the survival doesn't depend on automatic network generated incentives that are paid out meritocratically and randomly, the balance of power ends up remaining lopsided, right? Because it ends up being possible for the network creator to end up tampering, shutting down, or killing parts of the blockchain, right? So if from that point of view, when you look at many of the new age solutions that you hear about, which are not necessarily community driven, you will find that in principle, they are not very different from distributed databases across distributed servers, right? Which is in many ways distributed computing, right? So the thing to remember is that just because somebody creates a blockchain and allows stakeholders to view it or modify it, doesn't necessarily make it a blockchain that can withstand all attacks, even from within. So now that we've given a bit of a primer about what is blockchain, what is Bitcoin, let's also try to create an analogy to understand that what are some of the other cryptocurrencies that we can think of in the world of Bitcoin and others, right? So the analogy that we want to use is, if you imagine crypto as ice cream, and if you imagine the world's first ice cream, which was, say, vanilla, uh, Bitcoin was the base product that made people realize that ice cream could actually be a thing, right? So before Bitcoin was created, people did not know how to abstract a reality or a concept like Bitcoin, right? So it basically created the market for ice creams. But as you realize, before long, people are not satisfied with the same one base variant, right? So in the case of ice creams, people will say, I want to have chocolate or strawberry, which is based on people's preferences. In the context of crypto, people decide that they want to have different cryptos based on functionality needs. So you have an Ethereum, you have a Monero, and you have a ton of other uh, cryptocurrencies out there. In the case of uh, ice creams, you can say that maybe chocolate is the world's most popular flavor. But in the case of cryptocurrencies, the plain old vanilla is still right now the most popular flavor of crypto there is, right? A few factors for this. One, it has been around the longest from 2008 onwards, which makes it the most trustworthy. It's also survived multiple uh, ups and downs, bull runs, and bear markets. So it also ends up being called as the most reliable. And also, thirdly, there is no undue influence of the creator because nobody actually even now knows who Satoshi Nakamoto is, right? So in terms of cryptocurrencies and what are the options out there? There is a website known as coinmarketcap.com where you will see that the number of cryptocurrencies are now more than 9,000, which were about 4,000 plus about 4 years ago, right? Many of the older ones have perished, and many of the new ones will also probably perish as time goes by. At some point, it's possible that there will be a cryptocurrency apart from Bitcoin, which becomes the biggest, but as of now, it is still the biggest crypto out there, right? And this is just a brief primer on what are some of the top cryptos out there and what they end up doing, right? So we talked about Bitcoin. We have Ethereum at number 2, which is um, it's a blockchain system which allows you to execute smart contracts, right? So basically, if you want to enter into a conditional sort of trade with a friend to say, if an event X happens, then transfer money from person A to person B, then something like that is something that Ethereum allows you to do. The third largest is Tether, which is a stable coin, which ends up basically pegging to the US dollar. One Tether is expected to be the equivalent of $1. And the total market cap of Tether is about $62 billion. The fourth one is Binance Coin, which is actually a token run by the Binance crypto exchange. And it's used for a bunch of different purposes, including paying for transaction fees on Binance. right? The fifth one is ADA, known as Cardano. It's again something which allows you to uh, build smart contracts. In some ways, it is a competition for Ethereum. It's about $46 billion worth of market cap. Number six is Dogecoin. This has been one of the rising stars of the 2021 bull run, and a lot of people do believe that it is a meme coin. It was created in jest. However, it has found uh, a life of its own, and right now the market cap is as big as about $40 billion. The seventh one is XRP, which is uh, by a company that used to be called Ripple. Uh, it is a company that works on the distributed ledger technology, and it's basically looking to help banks manage their international money transfers using their technology, right? So there's an RTGS system, there's an XRP ledger, and so on and so forth. And competition for that is actually what we refer to as the SWIFT payment of uh, system of payments. Number eight is USDC, which is again very similar to Tether. There have been some aspersions cast on uh, the sanctity of Tether and the books and how clean those books are and all that, which is why I think you will see other stable coins also becoming a little more popular. And USDC is about $23 billion. There's another one which is Polkadot, which again is a platform that allows you to make multiple different blockchains operate with each other. Right now, you can't really, uh, from a Bitcoin network, go onto an Ethereum network. You actually need to have go through a centralized exchange and then make transactions that span from one to the other. Polkadot and some of the other ones this year have been the ones looking at creating interoperability across multiple blockchains. And similarly, we have at number 10, something known as Uniswap, which is one of the flagship cryptos in the decentralized finance space, and it ends up acting as an automated market maker, which allows you to actually go in and buy and sell any cryptos without actually having to relinquish control of the cryptos from your own wallet, right? So, and that is a different topic altogether, talking about centralized exchanges and decentralized exchanges. Unfortunately, that is not part of the scope of today's session, but please feel free to go up and read up more about that. Okay, so some of the other questions, which are crypto 101 questions people might have, which is how do you hold cryptocurrency, right? There is no banknote, there is no gold, there is no coin. So at the end of it, what you need to know is cryptocurrency is just an account which is protected by a password, which gives you access to that account, right? And the balance that is present within that account is the balance of your crypto. The account is what we refer to as the wallet, and the password is what we refer to as the private key, which, and they always come in intertwined pairs. So, which means that there is no one wallet with more than one private key, and there is no private key that can open more than one wallet, right? And what you need to remember is that if you are holding Bitcoin directly on the blockchain network, there is no password reset button, right? There have been historically millions of Bitcoins which have been lost just because people have been either careless or did not know that their private keys are things that they need to keep extremely safe, right? And finally, when you look at Bitcoin wallet and private key combinations, there are websites which allow you to generate any number of these wallet and private key pairs at no cost, right? So that is what we mean when we say holding cryptocurrency. It is at the end of the day held in a wallet and it is accessed by a private key, right? So some safety precautions that you want to keep in mind if you are getting involved. One, while creating a new wallet, keep the private key safe from anyone and everyone. The question is that some people might have is, how do you know that you're using the right private key? How does the world know? So the way cryptography works is that a private key ends up generating a public key, which ends up generating a wallet address, right? And each of these steps is irreversible, right? So you can't use a public key to recreate a private key, and you can't use a wallet address to recreate either the public or the private key. So this is what we refer to as the mathematical trapdoor relationship, right? Which is the whole cryptography f of x tends to y, which is that a function which is easy to perform in one direction, but practically impossible to perform in the opposite direction. And the entire security model of Bitcoin is underpinned by this unidirectionality, right? So when you make a transaction, it is broadcasted to the network with a signature that was made using the private key that you possess. And a signature, a digital signature, is something you can use to show that you know the private key without actually having to reveal the private key, right? So you can provide a digital signature to show that you possess the private key. You don't need to actually show the private key of a particular wallet address. Now, based on this process, what happens is the nodes on the network end up being able to validate that the private key that was used, that was correctly associated with the wallet address, was used. And knowing that confirmation, they then treat that transaction as valid, right? Because everyone knows that this is a unidirectionality function, which means that it is the right private key that was used for the particular wallet address, right? So now, talking a little bit more about wallets and private keys, uh, the two key differences, right, in compared to the regular financial banking network that you look at or the Bitcoin network that you look at, is that one, uh, none of these wallets need to have any KYC information associated with it. That is the way it is designed, right? Because um, it is a public ledger, and these are alphanumeric strings, and I will shortly show you what those are. They don't need any KYC information associated with it. And two, all wallet addresses end up being publicly visible to everyone. So a lot of people might think, that's a scary thing, or that's something where privacy is compromised. But it's actually not true, right? Because the way you look at it is, uh, anyone observing the network will be able to see the cryptocurrency moving in and out of the wallets, but they will not actually know who those owners of the wallets are, right? And as a result, it is pseudonymous. It is not anonymous, but it is not also public. It is halfway, which is pseudonymous, right? And this is what we see as the public distribution of all the Bitcoin wallets on the Bitcoin network, right? So as you will see, there are a handful of addresses which have between 100,000 to a million Bitcoins, 10,000 to 100,000, 1,000 to 10,000, and so on and so forth, right? Um, uh, Now, as you go and read up more about this, right, you might think that, some of these wallet addresses are too big to be ideally owned by any one single individual. But as you will realize, most of these big ones are not held by individuals, they are held by exchanges, right? And yeah, that is also something that we will try to cover as we go along the next few slides. So the Bitcoin address usually looks something like this, right? And a Bitcoin private key is actually a number which again looks something like this, right? And the only thing that protects the money in the wallet from people who want to steal or siphon off that money is the private key, right? But what you also need to remember is, on the blockchain network, for you to be able to make any transaction, and by transaction, I mean a spend transaction, you will need to enter the wallet address and the private key both, right? And as we can see, because of the nature of how these wallet keys and wallet addresses and private keys look, managing this becomes extremely cumbersome and unwieldy, right? That is where we now start seeing cryptocurrency exchanges, right? And we will talk about the role that cryptocurrency exchanges play in this space. So it primarily serves two purposes. One, it allows laymen to access crypto, right, by providing an easy to use platform, right? Which means people can receive cryptocurrency, people can send cryptocurrency, people can do all that by using an exchange which is designed with a certain UI to make it easier and less unwieldy and all that. And two, an exchange ends up creating liquidity and allows the buyers and the sellers who are looking to buy and sell or trade in cryptocurrencies from finding each other. It allows them to find each other. So what you need to remember is, like we said, the protocol of the blockchain network hasn't changed, right? And the way a cryptocurrency exchange ends up achieving that is it ends up taking over the cumbersome technical parts itself, right? Which means it lets you log in with your address and password, and they give you access to your wallet. And when you click on send, they sign that transaction with the private key and broadcast it to the network. However, to drive mass adoption, they unfortunately have to have no other choice than to hold all the private keys for all the user wallets, right? Actually, there aren't a million wallets for a million users. What they end up doing is they end up holding all of it in one single wallet. However, for those million users, they will provide access to a ledger, which will look as their account balance as they log into their crypto exchange, right? And this is why we will see, and we have seen, history has shown that centralized exchanges end up being the single biggest point of failure in the cryptocurrency ecosystem, right? And hackers end up targeting exchanges all the time, knowing that by getting access to the database, they will get access to the private keys and they will end up getting access to all the user funds. And historically, many crypto exchanges have been hacked, which have led to hundreds of millions worth of Bitcoin being stolen. That said, one should remember that Bitcoin as a network, as a protocol, has never been hacked. So all the hacks that you hear about are hacks where centralized exchanges have been compromised, where hackers have been able to go in. And when we talked about some of the big wallet addresses there, which hold, say, 100,000 Bitcoin, if it belongs to an exchange, the exchange private key, as at the minute it's compromised, it can be used to siphon off all that Bitcoin, which is in possession, which is belonging to millions of users, but being stored in one single wallet address, right? And with that, let's also slightly touch upon this concept known as forks, right? So when we talked about Bitcoin and the other cryptocurrency exchanges, at the end of the cryptocurrencies, at the end of the day, it is all software code, right, which is being run on different mining nodes. So what ends up happening, for different reasons, whether it's security, functionality, or anything else, the software needs to be upgraded, right? So you need to think of forks as nothing more than a software upgrade. Now, there are two types of forks, right? One is a soft fork, the other is a hard fork. Now, a soft fork happens when most of the developers who are working on a given project or a given crypto are in sync and in line with the changes that are being planned for the roadmap of that particular crypto, right? And in that case, there is what is known as a soft fork, which is, and the simplest analogy is, on your phone, if you were to install a software or an app and it is on version 1.0, and then later every week it gets upgraded to say 1.1 or 1.2, that is essentially what is happening in the case of a soft fork, right? The new version of software is then propagated and it is updated across all the nodes on that particular network. However, what ends up happening in the case of a hard fork is that there are different parts of the community who believe in different visions for that particular crypto, right? And there is no consensus for the immediate next steps. In that case, in this and based on the spirit of open source, the way the industry has evolved is that everyone is free to take the source code and take it in a trajectory that they think is best for that particular crypto, right? So this ends up splitting the chain into multiple parallel chains. Now, there are some downsides and there are some upsides to this, right? The downside is hard forks. It's a little risky because you should ideally not be withdrawing or sending crypto at that point because there are changes happening on the network, and it's likely that some of those transactions that you're making will get lost off of one or two of the chains, right? Which is what we're referring to, saying that it can disappear from one chain or the other. The upside of having a hard fork is that if you are holding coins on the original chain, after the hard fork, you end up holding an equivalent amount of coins on the new chain, right? Yeah, in many cases, it's not the same as doubling your money, but yes, it ends up being a bit of a windfall gain. And historically, you have seen that Ethereum split into Ethereum and Ethereum Classic, Bitcoin split into Bitcoin and Bitcoin Cash. So to look at the upside that we are talking about, if you were holding one Bitcoin pre-fork and then the hard fork happened, post fork, you would continue holding one Bitcoin and you would also automatically be given one Bitcoin Cash in the same in the copy of the ledger that was taken at the time of the fork, right? Overall, the value doesn't necessarily go up by 100%, but if the pre-fork value of a chain was say 100 units, in many cases, the post fork value of the chain probably ends up being say 90 units and maybe 15 to 20 units on the smaller chain, right? So overall, you go from 100 pre-fork to about 110, 115 post-fork. So that 10, 15 extra is actually a bit of a windfall gain, right? Now, we've talked about Bitcoin, we've talked about blockchain, we've talked about crypto. Let's now come back and talk a little bit about the legality of Bitcoin as we see it in multiple parts of the country, multiple parts of the world, including India, right? So if you look at what happened in India, right? So in 2018, the finance minister Arun Jaitley had quoted, the government does not consider cryptocurrencies as legal tender or coin and will take all measures to eliminate use of these crypto assets in financing illegitimate activities or as part of the payment system, which, contrary to what most people think, is actually very normal because most countries will not usually mandate anything apart from their existing fiat currency as legal tender, right? So in India, for example, only the Indian rupee is legal tender, right? You cannot, at the end of the day, use gold and go buy a car. You cannot use stocks and go buy an apartment, right? Everything needs to be converted back into rupees, and rupee is the only legal tender, which is fine. So a lot of people tend to arrive at this conclusion to say that if Bitcoin and crypto is not legal tender, then does it mean it is illegal, right? The point that we make is that's not necessarily the case because it currently occupies the legal space in India, which is best described as unregulated. Now, this was Feb 2018. Now, what happened after that was in April 2018, the RBI ended up asking the member banks to stop servicing crypto exchanges. This meant that there would be no banking relationships or bank accounts, which meant that effectively people were being cut off from the cryptocurrency exchange markets, right? Uh, in 2018, the cryptocurrency exchanges filed a court case to challenge this. The challenge was made on two grounds under the Indian Constitution. Article 19(1)(g), which allows citizens to carry the right to carry on any occupation, trade, or business, and Article 14, which prohibits discrimination and mandates equal protection under the law for all. Right? These were the two grounds on which the challenge was made. In February 2019, and then so on, the Supreme Court got the Union of India involved. The dates kept getting pushed out. What ended up finally happening on 4th of March last year is that the Supreme Court announced the verdict on the RBI ban and called it unconstitutional. Right? Since then, crypto exchanges have been back in business, and along with equity markets in the last year, have seen quite the boom through the pandemic. Right? Earlier this year in Jan, again, the market was filled with fear, uncertainty, and doubt over news reports of crypto getting banned. The uncertainty has continued. In May 2021, crypto exchanges started facing issues with banks again starting to withdraw services similar to what happened in 2018. And then towards the end of May, the RBI stepped in to state that the banks could no longer reference the 2018 RBI order, which had been overturned by the Supreme Court. Right. That said, the RBI has openly always made its anti-crypto position clear, but as of right now, there is not full clarity on what the government is thinking. Right now, with that said, in terms of the legality of Bitcoin in India, let's look at what we see around the world. So when we talk about legality, right, it basically means that it is an act or an agreement or a contract that is consistent with the law. Since there is no law in around Bitcoin, it continues to be legal, however unregulated, like we said, right? It also is said that an RBI will only end up influencing organizations which fall under its ambit, right? Which is in the case of the ban, what had happened was they had asked the banks, which fell under the RBI ambit, to behave a certain way. It also ends up being a little difficult for governments to end up dictating to people what people should or should not find value in. And finally, when you look at crypto, one analogy you want to use is all it would take is for one country to legalize it, because as we have seen in the case of tax havens as well, whoever is able uh, to legalize this officially will end up attracting the crypto wealth, or whatever you want to call it, in terms of talent from all over the world, right? So if you look at different status of Bitcoin in terms of legality, this is what it looks like, right? If you look at by union, the European Union or the G7, it's legal. If you look at by country or territory, in Africa, Algeria, Egypt, and Morocco is illegal. In most of the other places, including North America, it's legal. In some places, you see the use is discouraged by the central bank, or there is a banking ban, but it still remains legal. Again, if you look at other parts of the world, you see Bolivia, again, is the only one here in South America uh, uh, which has banned Bitcoin and made it illegal. And in Asia, again, we see Nepal is the one that has made it illegal. And if you look at the rest of the world, Southeast Asia or Europe or any other place, it's all pretty much legal, right? So it's only 5 countries which have gone out and explicitly made it illegal, which is Algeria, Egypt, Morocco, Bolivia, and Nepal. Yeah. So now a lot of people also would like to understand, right? How would a ban impact the Indian crypto space, right? And what ended up happening, like we said in 2018, was that when the RBI asked banks to stop servicing exchanges, it ended up cutting off the crypto exchanges from the liquidity that they needed to run their business, which means that retail customers can't buy in because there is no bank account belonging to the crypto exchange where a retail investor can send their money. And similarly, they are unable to withdraw their cryptocurrency in the form of fiat money because there is no exchange bank account which will send that money back to the retail investor's bank account. So what ended up happening in the industry after that, there was obviously a bit of a pull down in terms of volumes. Unrelated to the ban, CoinSecure was one of the leading ones, which ended up getting hacked. And then they ended up folding. Unocoin was a different crypto exchange, which ended up shutting down. ZepPay was another prime crypto exchange back then, which ended up moving to Malta. So other country markets, the founders later sold out, and now ZepPay has returned back to India, and it is headquartered out of Singapore, right? WazirX was one of the new ones at that point, and they ended up creating an innovative P2P solution to tackle with this RBI banking, right? And like we said earlier, uh, the ban was on banks not servicing crypto exchanges, right? The ban was not on actually trading in Bitcoin and cryptocurrency, right? So all the people who were participating also as part of the P2P option were not in any form breaking any of the existing laws, right? So the way it was designed, the P2P, was that WazirX ends up acting as escrow, right? It ends up connecting the buyer to the seller, and it ends up holding the crypto funds on behalf of the seller, right? And when the seller confirms that they have received direct money transfer from the buyer, then WazirX ends up releasing the crypto to the buyer after deducting a small fee, right? And from a point of view of implementation, it becomes next to impossible for anyone to actually uh, go after a solution like this because uh, on record, it only ends up showing that people are transferring money to each other, which happens all the time for a million different reasons, right? So that is the way the industry actually managed to find a way to keep the ecosystem going, which was through the P2P option that we are talking about. Now, when we talk about the cryptocurrency bill, there have been two versions of the bill that we have heard of. One was the 2019 bill, in which the proposal was not only to ban investment trading, but also to ban possession. And the draft bill ended up containing terms which were as severe as up to 10 years in prison or up to 25 crores in fines, right? That was the severity of the language that was part of the draft of the 2019 bill. The 2021 bill, it is not yet out in the public domain, right? However, there are some points which we have heard of and noticed. One of those is that there seems to be some confusion around what constitutes private cryptocurrencies. It is possible that the trigger is because of the cryptocurrency term, and it could be that uh, the approach is to rename it or reterm it as crypto assets and then let cryptocurrencies get treated as crypto assets the way you do for stocks and the way you do for other sort of investment vehicles, right? A lot of it will also end up depending on whether investing versus trading versus possession, what gets criminalized, if at all, and of that, how much of that is retrospective, if at all, right? Finally, the other take is that when people talk about there being a possible liquidation window, the way we see it, that liquidation window is actually not very useful because at the end of it, if people are told that you have 3 months or 6 months to liquidate your current holdings, um, if buyers and sellers are both in the same boat, um, that liquidation will not work, right? Because the buyers will not want to buy what the sellers are wanting to sell because everyone is racing against the same sort of liquidation window deadline, right? So this is what is a bit of a summary in terms of how a ban might impact the Indian space, right? Now, if people are curious and if people are so inclined that they would want to get in, there are a few slides talking about what one should keep in mind if one is looking to get in, right? One, you look for crypto exchanges that let you register, right? A ban would effectively mean that Indian exchanges will stop registrations. Two, it is important to find crypto exchanges that do proper KYC, right? And this is true around the world. In the absence of government regulation, exchanges have been self-regulating for KYC since a while now. So the Indian exchanges end up asking you for your PAN, your Aadhaar, your Indian bank accounts. The international exchanges ask for government-issued IDs like driving licenses and passports, right? And it is also advisable to always look for reliable exchanges which do KYC because it's possible that exchanges that are not stringent on KYC are likely already being used by money launderers. And something similar happened in 2017, where there was this exchange called BTCE, which got shut down by the FBI in connection with some money laundering that was happening for Russian criminals, right? So some of the reliable exchanges that one hears about, Indian ones are WazirX, CoinDCX, international ones are Binance, Bittrex, and Coinbase, which, as some of you might know, underwent a recent IPO in the US markets, right? Also, you want to find a fiat mechanism that works for you, which means that the ability to transfer money in or transfer money out, which is also known as an on-ramp or an off-ramp. Indian exchanges will let you do it using NEFT, IMPS, UPI, any of these protocols. The international ones will let you do it through wire transfers or credit cards, right? But you also have to keep in mind that there will be associated transaction fees, right? Uh, for getting in, the cheapest and the quickest options usually end up being the Indian exchanges, right? Also, while getting in, you want to look for crypto exchanges that offer you the choice you need, right? Which means that of the 9,000 plus cryptos that we talked about, most exchanges will not have more than 200 or 300 listed um, cryptocurrencies, right? So the Indian ones usually have about 100 odd. The international ones have maybe 200 or so. So you want to look for crypto exchanges that end up offering you the inventory of crypto that you are looking to invest in. And finally, find exchanges that let you be safe, that allow you to enable two-factor authentication. And if you're doing that, please use an authenticator app, and that is since that is definitely more superior than a regular SMS OTP sort of setup. Yeah. In terms of how do you stay in, uh, like bank accounts and moving money from one to the other, crypto exchanges also allow you to move holdings from one exchange to the other, right? It takes time depending on the type of token that one is moving. It can take 30 to 60 minutes for Bitcoin to move from one wallet to another, and something like an XRP might actually take less than 2 minutes, right? Same for Ethereum. Transaction fees, like we said, it is not linked to the value of the transfer, but they are dependent on the market price of the crypto that one is using, right? So in at different points of the year, Bitcoin to Bitcoin transaction might actually cost about $10, and a Ripple might actually cost like 50 cents. Another advice is it is not advisable to hold crypto on exchanges for prolonged periods of time because of what we talked about earlier, which is the fact that they are magnets for hackers who are trying to obviously get in and get a hold of everyone's funds. So if one is not actively trading, it is not advisable to hold it on a crypto exchange. It is best to move it on to a paper wallet or a hardware wallet and keep those safely, right? So paper wallets are just pieces of paper with the private key and the wallet address documented, and hardware wallets are encrypted USB drives that with physical buttons that nobody can actually hack into without having physical access to that device, right? Couple of things to keep in mind: international exchanges do not offer INR on ramps or off ramps, right? And one easy way to use international exchanges, if one is doing that, is to use crypto itself to transfer money, transfer crypto there and transfer crypto back. And one other pro tip, if you're getting into any exchange with any crypto, do not load crypto without completion of KYC, because some exchanges allow you to move in crypto without KYC completion, but most exchanges, if not all, will not allow you to move your crypto out unless KYC is completed successfully. And you would rather finish that off in advance before you put in any of your money, lest it gets stuck. Okay. In terms of how does one get out, how do you liquidate, right? Like we said, you can always trade crypto for other crypto based on trading pairs like BTC, USDT, INR, and many others. On Indian exchanges, you can sell cryptos for INR and withdraw that INR to your bank account using NEFT or IMPS, right? If you want to use crypto, you can spend it on different purposes. There are around the world multiple platforms for shopping, for travel, for cruises, for hotels, for food, all of that, which are available. Or you can actually end up using it for the longer term and for dates when crypto is more acceptable as a uh, investment platform, right? Also, a few things that one should keep in mind when we're talking about taxation, right? The general advice is that you want to use FIFO in terms of the approach for tax liability calculation, which also means that in a bullish market, tax liability ends up being a bit higher, but that happens only if you sell, right? Uh, in some jurisdictions, crypto is looked at as being liable for tax by looking at every trade, and every trade is looked at as a taxable event, which means that it is important for all of you to maintain diligent records of all your transactions and trades, right? And let me take a minute to explain what we mean by taxable events, right? So if you look at buying, for example, 10 grams of gold worth 40,000 rupees, and that gold appreciates to 60,000 rupees, and then you say, okay, fine, let me use 5 grams of that gold and buy 500 grams of silver, right, for 30,000, because now the value of your 5 grams of gold is now gone to 30, and you exchange it for silver, you should know the tax liability is, you do have a tax liability on the profit of 10K, right? Which means that the 5 grams of gold that you bought at actually a 20K, which was liquidated at 30K, that difference of 10K, there is a tax liability on that appreciation of value. So it does not matter that you never sold gold for INR. What matters is that you ended up liquidating gold, right? And in case that trade is profitable, you are on the hook for tax liability. Now, the way you want to do this is obviously you need to have your your books in order. You need to have your FIFO calculators, which are able to help you figure out what is the tax liability if you're moving from different cryptos from one to the other, right? In terms of India, there is no formal guidance even now from the income tax department. I do recall that it was said maybe a month or two ago that even in the absence of any formal guidance, the income tax department is still expecting people will pay taxes on profits that they make, which I think is definitely sound advice. If you speak to some CAs, this is what the advice is summarized as, which is that if you are an active trader, you need to add your crypto income as income from other sources and address it as per tax slab. But if you are an active trader, maybe it is possible for you to position yourself as an investor and look at capital gains as a short-term or a long-term timeline, and then accordingly use the appropriate tax slabs. However, there is no clear definition of an active trader, right? Now, these were some of the reasons that we talked about. Some of the concepts around taxation and how does one get in, how does one get out. But let's maybe spend some time talking about why people might not want to get in, right? And these are some of those common concerns that we hear when people talk about crypto. Now, yeah, so one of the complaints is that Bitcoin is already so expensive, right? So the price is too high or the fees are too high, right? So one of the common refrains is, I can't buy a Bitcoin because $60,000 is too much to spend. What most people might not have realized is that all these cryptos were designed for fractional ownership, right? And Bitcoin is divided into 100 million units. Each of them is known as a Satoshi. That's about 10 raised to the power 8, right? You are free to buy as much or as little of the Bitcoin as you would like. And it does not matter at the end of the day how many units you have. It only ends up mattering how much percentage growth has your investment shown in terms of appreciation, right? In terms of the other complaint that we usually hear is that the fees are too high, right? And it's, for example, a couple of days ago, the transaction fee was about $5 for you to send Bitcoin from any one wallet address to any other wallet address, right? And as we have seen, when prices go up, so do the transaction fees, right? So we have seen this peak all the way to like $20 earlier this year, and in some cases, actually even going beyond $50. Now, at $5 a transaction, understandably, it doesn't make sense to use Bitcoin for anything which is a micro transaction, right? Or a regular day-to-day transaction, like buying a cup of coffee, right? And there are cryptos which are faster and cheaper, which let you do that, right? So Bitcoin's use case has ended up evolving to being a store of value, which can be sent across the world within now, right? And what that means is, even at spreads of 2%, which is what you would see in, say, a regular transaction, uh, the $5 transaction fee that we are seeing today, it ends up being profitable the minute you're trying to send more than $250, right? So if you're sending $500 or $1,000 or more, you will still end up spending just the $5, and it would not be increasing corresponding to the value of the transaction. Now, some of the other reasons why people like to stay away or believe that it's best to stay away, there are talks about the scams that happen in the crypto space, right? And usually you will see three types of scams. One are the get-rich-quick ones, right? So we have discussed the importance of private keys. It's like giving somebody your bank password or your ATM pin or the CVV pin at the back of your credit card, which you would not do in real life, right? But however, on the internet, we have seen that thousands of people have ended up trusting strangers and done exactly that, right? So tons of people have fallen for the oldest trick in the book, which is that people say, you give me your money today and I'll double it and give it to you tomorrow. And once that money is sent, obviously, the money never comes back, right? So these are dumb scams, which basically mean that you are making decisions using crypto money that you would not make in real life with fiat money, right? The other one is the Ponzi sort of scams that you see. where people say that, we are guaranteeing you an X% return on your investments, right? And there is no business in the world that can generate a 1% daily return. And the math basically shows that, a 1% daily return would mean that $1,000 turns into 37,000 in 1 year, 1.4 million in 2 years, 54 million in 3 years, and about $2 billion in 4 years, right? But there are millions of people who fall for similarly designed cryptocurrency offers, which are nothing more than Ponzi schemes. And finally, there were a lot of ICOs, which were all the rage in 2017, 2018, which were, at the end of the day, not all of them were scams, but many were. The challenges were, many of them were half-baked. They happened at the peak of the 2017 bull run. The amount of money that they raised in the form of cryptocurrency was already uh, uh, inflated, right? So when the market crashed, their holdings crashed in terms of value, and then as a result, many of them could not actually go ahead and deliver on the roadmap that they had envisioned. So a lot of people who invested in a lot of ICOs ended up losing a lot of their money, right? These are the three kinds of scams uh, that you want to just keep in mind if you are keeping an eye out for those. Right now, let's also talk about uh, some of the opinions that we have seen from people are in different domains when it comes to being supportive or being retractors of the cryptocurrency space, right? So on the supporting side, uh, uh, yeah, it's not too much of a surprise that we are not seeing too many people from central banks around the world who are very supportive of anything decentralized like Bitcoin. In terms of the Fed, we have seen Alan Greenspan refer to it as a bubble. In February this year, the Secretary of Treasury, Janet Yellen, called it highly speculative, right? If you look at the world of economists, right, a lot of economists have actually said, it's a bubble, right? So 2014, 2017, Paul Krugman, Nouriel Roubini, James Heckman, a lot of them have actually said not so nice things about Bitcoin and cryptocurrencies. Uh, however, the supporter side, if you go back and you look at Frederick von Hayek in his book, The Denationalization of Money, he talks about concepts which are very, very similar to what Bitcoin has turned out to be, right? In which he advocates basically a complete free market in the production, distribution, and management of money to end the monopoly of central banks, right? If you look at the world of finance and VCs, you have the Winklevoss twins, whom we all remember from being the guys who were involved with Zuckerberg and Facebook. You have Peter Thiel, you have Adam Draper, you have Jamie Dimon, and all these guys who are on the positive side, right? And finally, if you look at institutional investors, um, we have Warren Buffett, who is called Bitcoin rat poison squared. But on the institutional side with technology and finance, you have a lot of people, including Michael Saylor, who is the CEO of MicroStrategy. And we earlier talked about Jack Dorsey. We all know Elon Musk, right? All these guys have come out in support of Bitcoin and cryptocurrency space, right? Very interestingly, we have also seen in the last 3-4 years the endowment funds of Harvard, Yale, Brown, and University of Michigan, maybe amongst many others, who have quietly been also picking up and buying Bitcoin as part of their endowment fund investment strategy. Okay, in terms of other um, criticisms that we see, one of those is talking about how the fact that Bitcoin is a bubble, but there are enough people out there who believe that it's no longer a bubble. There's a growing acceptance of Bitcoin as legal tender. There's more merchant adoption. It's acting as a store of wealth in distressed economies. It's gone mainstream. There's limited supply, right? So what we are seeing is that after the 2017 decline, and the new emergence of crypto from last year, what we are seeing is that the bubbles the so-called bubbles are likely a product of the programming, which is that since the supply of Bitcoins gets halved on a 4-year cadence, it almost ends up creating a self-fulfilling prophecy of a 4-year sort of a boom and a bust cycle, right? Which is what we are seeing, right? And right now, still, I think 2-3 months ago, Bitcoin did end up reaching um, an all-time high, which was about, I think, $65,000, and now it's dropped back to about $35,000. It remains to be seen whether uh, 65 was the peak of this particular cycle. But yeah, only time, I guess, will tell how that turns out, right? And this is just an infographic, a comic strip, which talks about how the narrative hasn't changed, whereas the reality seems to have changed over the years, right? There are some other criticisms that we see. One is the fact that it's called as the great fool theory, which is that people are saying that, people are only getting in because they can end up selling it to other people um, who don't think that it is undervalued, overvalued, and it will probably keep going up till the time there are no greater fools left, and then it will collapse all of a sudden, right? So the analogy that one wants to look at is not actually the greater fool theory, but there is a history lesson for us from what we've seen with crude oil, right? So prior to the 1800s, crude oil was mostly a nuisance, right? And pioneers who were digging for water would actually end up finding oil and be disappointed because they did not actually know the utility of oil, right? However, in the 1850s, when there was a big breakthrough where it was discovered that rock oil could actually be processed and used as an illuminant, and it was able to replace coal oil, and it was also something that could be used as a lubricant for machines. That led to the industry creation around oil, right? And the turn of the century saw engineers experimenting with internal combustion machines and automobiles and other things ended up creating the demand for oil, which ended up skyrocketing, right? Now, the analogy that we want to use is that Bitcoin today is similar to oil after the development of the kerosene lamp, but before the rest of the inventions that actually ended up using oil, right? So it's a commodity with limited but meaningful real world uses, like one, storing savings outside of the fiat system, two, moving money across borders, three, settling large transactions quickly and irreversibly, and four, providing a release wall for citizens who are concerned about oppressive regimes and finding a way to expatriate money with limited to no physical risks, right? So the way to look at it is that similar to oil in the 1800s, the applications that we have right now are just scratching the surface of the potential that Bitcoin has, right? So in the case of oil, kerosene lamps were the proof of concept, but the real value of oil was that it was a store of energy that could be easily transported and released in an intense fashion. In the case of Bitcoin, the utility is limited. The real value is in allowing money to move at internet speeds and being held in an autonomous fashion, right? So this is the way one would probably want to look at Bitcoin and crypto in terms of analogies. Now, there are some other narratives also. Um, One that we see time and again and comes up in most countries is the fact that cryptocurrencies are concerning because they are used for criminal activity and terrorist finance, right? And this is something that Janet Yellen also shared earlier this year, right? However, if you look at some of the research that is done, and there is a Chainalysis report of 2021, which basically says that criminal activity represents about 2.1% of all crypto volume in 2019, which was about $21 billion of volume. In 2020, that share actually fell down to about 1/3 of 1%, which is 0.34. The share of non-crypto money used for criminal activity, according to the UN, is actually estimated to be between 2% and 5% of global GDP, which, if you compare, you're comparing $10 billion to about 800 billion to $2,000 billion, which is from the fiat sort of fiat money that is being used for money laundering and illicit activity, right? So if you look at the difference in the share in the scale, it's 0.34% to 2%, which is 1/6. And if you look at the value, it's about 10 billion to about 800 billion, which is like just over 1% of the value, right? So for those listening, this basically shows that criminal activity or crypto transactions is much, much smaller than what is used from fiat currencies, right? And this was something which I tweeted a while ago, which was to say that, folks who cast aspersions on the use of a digital public ledger for illegal activities need to be reminded that nothing is more anonymous and untraceable than cash, right? The other criticisms that one finds are around tulip mania, right? So as we explore this particular topic, let's understand what some of the key similarities are, right? So Bitcoin and tulips both have become highly valued assets. Both are used by speculators as investment tools. Both have had historic price rises, and both have been highly sought after. However, that's where the similarities end, right? The key differences are, in the case of tulips, there was mortality that had to be dealt with. There was a limited lifespan. Uh, in terms of tulips, it was non-fungibility that has to be dealt with, because it was not just one type of tulip. There were multiple mutations that were available. In terms of tulips, there was also unpredictability, because it was very difficult to ascertain what would be the final look or the appearance of the tulip by looking at the bulb. Uh, the fourth element is unsecure asset management, because tulips also required safe transportation to be kept safe from being stolen. And the other element to be looked at was non-divisibility, which was again a limitation for tulips. You couldn't really trade a part of a tulip. And finally, there was a lack of a global exchange market for tulips, right? Which is what we see when there is enough liquidity and transparency and real-time price discovery and settlement that happens in the case of Bitcoin. So these are many of the differences between tulip mania and Bitcoin mania. And finally, tulip mania lasted for about 3 years in one country, almost 400 years ago, right? Bitcoin mania has been around for about 12 years now, and it's around the world, and it's in today's age, right? So if you look at the similarities and the differences, you will probably realize that there are more differences than similarities between Bitcoin and tulips. Okay. In terms of other criticisms, one is around Bitcoin energy consumption, right? So there is a website, which is the Cambridge Bitcoin Electricity Consumption Index, right? Which ends up doing a lot of analysis, right? So if you look at the amount of power that Bitcoin consumes, right? Recently, it was about 100 terawatt hours per year, which is the equivalent of a small country, right? Which is, if you compare it to nation states, you realize that it is at rank 34, between Netherlands at 33 and Philippines at 35, right? The question many people ask is, should Bitcoin energy consumption rival that of an entire nation, right? But then what you want to do is, you can't just look at the cost, you also look at the upside, and you say, okay, let's look at the GDP of Philippines, which was say about 480 billion. Kazakhstan, which is I think next in line, is about 160 billion, right? So if you look at the value of Bitcoin, it's basically a monetary base of more than 650 billion, which is actually greater than the combined GDP of Philippines and Kazakhstan, right? So for people who believe in Bitcoin, the energy expenditure is a small price to pay for something that is censorship resistant and a digital bearer asset, right? And it ends up being the sixth largest base money on Earth, with only the US, China, the Euro, Japan, and the UK being ahead of the Bitcoin market, right? Also, supporters contend that the proof of work consensus mechanism is a work of unparalleled genius, and it is something that is it's okay if it ends up using uh, energy consumption to keep that network going, right? A couple of fun facts to keep in mind. If you look at the amount of electricity that is used in the US, in home devices that are plugged in, always on, but not being actively used, that amount of electricity can actually end up powering the Bitcoin network for more than 2 years, right? And similarly, if you look at total energy production in the world and total energy consumption in the world, Bitcoin is less than 0.5%, right? So depending on which side of the debate you're on, you will likely see enough reasons to criticize Bitcoin on energy consumption, or actually end up defending it against those accusations, right? And finally, looking at some of the criticisms, if you look at the financial services space, these are some of the headlines that one has come across over the years, right? So if you look at this, Morgan Stanley saying the real value could be zero, and then Morgan Stanley becoming the first bank to offer wealthy clients access to Bitcoin. Same with JP Morgan, same with Goldman Sachs, Deutsche Bank, Visa, PayPal, ING, right? So needless to say, all the headlines that you see on the left happened earlier, and all the headlines that you're seeing on the right happened later, right? So criticisms, as we have seen, are par for the course. And this is one of those quotes which is referred to usually in the crypto space, right? So now looking to wrap things up, the journey so far. So what we've done is we've covered the why, the what, and the why not. We've also covered a bit of the how. What we have not covered are decisions around the when, right? Which is if people are looking to get involved, when should they get involved? And they don't necessarily warrant a format of presentation. And in terms of a risk appetite, that is what you need to evaluate for yourself if you are looking to answer the question of how much. A bit of sage wisdom for good luck, right? These are some of the pieces of advice that you will find in the crypto space. DYOR, which is do your own research. If you're getting in, don't buy near the all-time high, the ATH. Two, no purchase is too small. Like we said, 100 million units called Satoshis. Some Indian exchanges allow you to start buying with as little as 100 rupees. People take years to build up to even 1 Bitcoin worth of holdings, right? So don't worry, and you don't have to beat yourself up over the fact that you don't start with buying one full Bitcoin, right? Some other sage wisdom, buy when there is blood on the street, even if the blood is your own. Buy the effing dip. Risk management, invest only as much as you are willing to lose. Do not invest with borrowed money, not your keys, not your Bitcoin, which means that if you do not have access to your private keys, you do not, at the end of the day, have access to your Bitcoin. So you need to take it off of crypto exchanges and keep that private key safe. And finally, there's a term known as HODL, which is actually a misspelled HOLD, hold word, which was on a Bitcoin forum post from 7-8 years ago. And it basically is backronym now to describe somebody who ends up just buying and holding on for dear life, right? Finally, a couple of meta lessons in terms of crypto. Pay attention when stuff is early and weird, right? Exercise your imagination in figuring out how something can get big. If you have if you conduct a sniff test and it passes your sniff test, invest 1%, it will easily become 10% or 100% or 1,000% if things go well, right? So pay attention when stuff is early and weird. And two, accumulate during the plateau. So whenever there is a boom and a bust cycle, use the boom cycle to make up your mind, to do your research, to decide what you want to do if you want to get in, and use the bust part of that cycle to actually get in and accumulate, right? So build your positions when the prices have fallen, and yeah, that is what this says. And finally, with that, these are some of the sources, and this is the end of my presentation, right? I don't know how long it has taken, but I'm guessing, yeah, it's been about an hour and a half. And with that, handing it back to you, Akhilesh.
Thank you so much, Kamal. I think, first of all, congratulations on the amazing stamina of lasting almost 100 minutes. And I can see from the number of participants that have remained within for the last 100 minutes or so that this has been a spectacular session. We are beginning to see many of those chats and the Q&As coming through. Thank you so much for doing this. To all the people who have attended, we also want to highlight that this is something which is only a kickstart of our series. Kamal will be with us over the next few weeks as we reach out and discuss more with policymakers and other stakeholders in the Bitcoin and the cryptocurrency ecosystem. So we look forward to seeing you all again as we publish more details of who we are getting and who we will be speaking with in various social media platforms like LinkedIn, Twitter, etc. If you're an alumni, you will also be receiving emails and also on your batch WhatsApp groups, etc. Kamal, thank you again so much for this.
Sure. Thank you so much. Thank you, everyone.